What's up, guys? And welcome back to another episode of the MD Investor, the channel where we talk personal finance to get your money right, increasing our financial IQ so we can teach our children and break the cycle of generational poverty. Today, we're continuing in our series of building a dividend portfolio from the ground up. Building a dividend portfolio from the ground up. And today's episode is going to be part 3 in that series. We're talking about diversification, right? We don't want to have all our eggs in one basket. We can't have all our money invested in one company or even a few companies, right? We can't have all our money invested in one company because if that one company goes down, there goes all our passive income. So we have to spread it around. A little here, a little there. Diversification. Like your mom used to say, don't have all your eggs in one basket. Because if that basket breaks, then you have no more eggs. All right, so we got to spread it around. So 2 things we're going to consider in diversification. 1, we're going to diversify by the amount of companies we hold, right? Because think about it. We are building this portfolio to generate income every month that we don't have to work for. And we want to make sure that money continues to flow, right? If something happens over here, we don't want it to really significantly affect us. So the first thing we have to think about is, how many companies are we investing in? Like we said, we can't have all our money in McDonald's. Just to use an example from the previous video. If something happens and McDonald's gets into trouble, right? People all of a sudden decide they're going to eat super healthy and their revenues, earnings go down, and McDonald's have to make a decision to cut the dividend because we said dividends are not guaranteed, right? They have to be approved by the board of directors. And all of a sudden, all your 100% of your passive income was coming from McDonald's. Suspended dividend. There goes all of your passive income. So we have to diversify by the number of companies. There's somewhere in the range of 15 to 20 companies on the low end for your dividend portfolio. So these are 15 companies that you have to kind of follow and track and look at their earnings and look at their revenue and look at their debt and look at their quarterly report and their annual report, and let's do the conference calls. So you see, it can take a little time. On the high end, people can have a portfolio with 50, 60 companies, but you see it becomes, more work, essentially. So if the direction we're going to go is individual stocks, then that's one way to go. And there's another option, which is a dividend ETF. They are ETF, which stands for exchange traded fund, which basically invest in a basket or a group of stocks, right? And they do all, you invest in a basket of stocks. You buy one share of the dividend ETF, and then you have a little piece of all the companies that ETFs invest in. Less work for you. All you have to do is do your research on the ETF, the companies they hold. Are you okay with them? The dividend yield that they're giving, are you okay with that? So the expense ratio or the amount of money you're paying. We'll do another video on dividend ETF to get into details, but just to let you know, there are 2 ways to go about it. The one way we're doing it, the active way, the way that we're doing the work. The number of companies we hold are going to be the first thing we have to consider. 15 to 20 on the low end, and then on the high end, you're talking about up to maybe 50 or 60 companies, which is a lot. So that's the first thing you have to consider. You have to know, and you have to make the decision that's right for you. The next thing, in terms of getting diversified, as we're building our dividend portfolio, is what are we going to invest in? We have to be diversified by sectors. So the next thing that we have to consider when building our dividend portfolio is sector diversification. The stock market is made up of 11 different sectors, okay? So each company in the stock market can be put into one of these categories, and we're going to go through them. The first one we'll mention is the information technology sector. The information technology sector, by market cap or by the size of the companies, makes up the largest portion. These are your big mega cap companies. So these are your Apple, worth $3 trillion, right? These are your Amazon. These are your Google, right? Even though Google doesn't pay a dividend. These are your Microsoft, right? Broadcom, a company that makes semiconductors for the computer. So you have to be diversified. So you want to have some of your money into the information technology space. Now, a lot of these companies in the information technology space are new to paying dividends, and their dividends are very low yielding. So you have to consider that too. These dividends are low yielding, but they do grow the dividend nicely. You have to take that into consideration too. How old are you? When are you going to be ready to start cashing those dividends in and living on them? But that's something that only you can decide. So the information technology space, so you want to have some of your money in the information technology space. Obviously, you don't want to be overloaded, like have 90% of your money in one sector, but it has to be spread out in a way that is comfortable for you. The next sector that you're going to want to have money in is the healthcare sector, right? We just went through a worldwide health situation in 2020, and you see how important those companies were. Companies like BioNTech and Moderna and Johnson & Johnson, who are making vaccines. So you want to have some money in the healthcare space. So how many big pharma companies do you need? Right, you'll have to kind of decide. Do you need Johnson & Johnson, Merck, Eli Lilly, all together? Maybe not. Right? So again, you have to consider, I don't need 5 farm companies, but maybe in your situation, maybe you do. You want to diversify your risk out a little in case one company stumbles, you have money in another one. And there's also companies in the healthcare space that makes medical devices, not just drugs. You want to have some of your portfolio in the consumer staples. What are the consumer staples? Consumer staples are companies that make stuff that we actually need, no matter what. If the economy is up or down, you need to eat. So a company that sells food, so like something like Walmart, you can buy your clothes, or you need clothes. You can buy your food. Target, again, food and clothes. Companies that make feminine products, like Kimberly Clark, Procter & Gamble, that makes soap and detergent and toothpaste, the basic necessities. That's what you think about when you think about consumer staples. So you have to decide, right? How many in your slice of your consumer staple do you want, and how much percentage you want to allocate to it. And again, the evaluation, their earnings, their debt, their dividends, the dividend growth, right? All of these things you have to consider, okay? Then you have your consumer discretionary. These are companies that are in a tough situation when the economy is down. You can say, you know what? I'm not going to do that. So companies would be like in a restaurant space. When the economy is down during the recession, I'm going to cook and eat at home. I'm not going to go out to Olive Garden. So Darden, which is the company that owns Olive Garden and other restaurants, may have a hit during a worldwide health crisis like they did, and maybe have to cut their dividend because people were not going out to the restaurants. All right. Do you want to have 10 of those companies? Right. So you see how if your portfolio was made up of 100% of companies in the travel, hotel, and restaurants, which are all in the consumer discretionary space, and a lot of them were not doing well during the health crisis, your dividends would have been cut. That's why you have to diversify. Whereas other companies were doing okay. So that's why you want to, and they would mitigate your loss in dividend. That's why you want to be diversified. Okay, so that's a consumer discretionary. So that's your hotels, that's your travel, that's your restaurants. Now, the next one we look at is finance. How much money are you going to allocate to the sector of finance? Finance would include your banks, not just your big banks like Bank of America, or JP Morgan, and Citibank, and so on, but your regional banks, right? M&T and all these different things. Your insurance companies, right? So your Allstate and a Progressive, and also your credit card company. So these are in your financial sector. How much are you going to allocate to your financial sector? And again, look at the individual companies who are the market leaders, right? Who are the big boys with the big market share. Look at their dividends. Look at their dividend history. Look at their dividend growth. Look at their earnings. Again, the same repetitive technique to evaluate all the companies. Next, we want to look at how much of your money you're going to put in the material space, which is the next sector. Material space, those are companies that actually go in, get the raw materials that companies need to operate, right? There are companies that actually go and dig into the ground to get the lithium to put into your lithium batteries, to run the scooters and all the watches that make the lithium batteries and everything else that uses lithium batteries. So a company like Albemarle Corporation, ticker ALB, would be that company. There's companies out there that there's companies out there, and they get or manufacture things like oxygen or helium or hydrogen, that are used in different industry, right? Company like Air Products, a company like Air Products and Chemicals, ticker APD. Somebody got to do it, right? When you go to the hospital and there's oxygen on the wall, where did that come from? Or the welder that they use the nitrogen, where did that come from? Like, somebody got to manufacture it, right? And there's companies that do that. Companies like Dow Chemical, companies like DuPont. So how much are you going to allocate? Who are the market leaders in that sector? How are they doing compared to their competitors? How long have they been instituting a dividend? How are they growing the dividend? What are they earning? What are they, again, all over again? How much of your money are you going to allocate to companies in the industrial space? These are the companies that make stuff. So a company like 3M that makes everything from the Post-it note, to the stethoscope that I used to wear, the Littman stethoscope. Company like Caterpillar, right? Those big, heavy machinery used in construction, used in infrastructure, right? Now America's on they want to rebuild the bridges and the tunnels and the piping for the water underground. That's all heavy duty machinery, and a company like Caterpillar is perfect for that. All right. So these are companies in the industrial space. A company like Boeing that makes airplanes. Again, how are they doing in terms of the competition? How long have they been, instituting dividends? Look at their earning. Look at their debt. Look at their revenues. How they've been doing year over year or quarter over quarter. How much of your money are you going to allocate to the energy sector? Those are companies like Exxon and Chevron and these big BP, these big gas companies, right? Not only do they take the oil out of the ground, but then they're transported. They're companies that they transport oil from the ground to the factory, right? So these are companies that you can invest into as well. And then when the oil gets to where they get to, then they have to be processed. And there's companies that does that too. It's called upstream and it's called downstream, and then the section in the middle is just called the transport. How much percentage are you going to allocate? Who are the market leaders? How have they been doing? How are they doing business wise? How they growing their dividend? How much of your money you're going to put into the telecom space, right? Those are your AT&T and your Verizon and your Disney, and again, who are the market leaders? How they competing? How their debt, right? You got to do that research, right? How much of your money are you going to put into the utility space? So these are your companies that, or your regulated utilities. Depending where you live in the country, it could be Con Edison if you live in the New York Northeast area. It could be Dominion Energy. It could be Southern Company. But these are your regulated utility companies. How much of your money are you going to put there? We know they don't grow their dividends that much, but they're consistent because people do pay their power bill. That's one thing. They will not take your medication, but they'll pay their power bill. And then the last sector is real estate. How much of your money are you going to put in that sector? In the real estate, we have options such as REITs, real estate investment trust, that we can invest in, right? So stocks like Simon Properties. Simon Properties is a big REIT that invests in shopping malls. If you go to one of their properties, you'll see a Simon property, right? I mean, it's one of their properties that's in their real estate investing trust, and you can invest in Simon properties, and they pay a dividend, right? Their specialization in the real estate space. Some of them are self-storage, right? You can invest in a company that specializes in self-storage. So some of them specialize in self-storage. Some specialize in hotels. Some specialize in malls. But again, this is your real estate portion. One thing about REITs, their dividends are not qualified. A qualified dividend is what you get from McDonald's or Johnson & Johnson if you own within a specified time frame. Mm-hmm. And the advantage of a qualified dividend is that they're taxed at a lower rate. They're taxed at the long-term capital gains rate, which for some people could be 0, for some people could be 15%, and for some people could be 20%, depending on your gross income. REITs are not given that qualified dividend treatment. They're considered ordinary dividends, and they're taxed at your ordinary tax rate, whatever break or bracket you fall in based on your income. The only way to avoid this, paying this higher tax on your dividends from REITs, would be to hold your REIT in a Roth IRA. If you hold your REIT in a Roth IRA, then everything is tax-free because the tax was already paid up front. So guys, so these are some of the considerations when you're building your portfolio from the ground up. Again, if this is something you would not want to do, then you would want to buy a dividend ETF. And I've done a previous video on dividend ETF, but I'm going to redo it because there are some advantages. There's some advantages and there's some disadvantages. So again, guys, when you're building your dividend portfolio from the ground up, you want to be diversified. You don't want anything to rock you and stop your dividend or passive income from coming in. So you want nothing to stop or prevent your dividend income from coming in. So you want to be diversified with the number of stocks, anywhere between maybe say 50 to 20 on the low end and maybe up to 50 on the high end. And you want to be diversified by sectors. We went through the 11 different sectors. You want to have portion in each of them and then look at the companies individually. So again, from 1 to 11, the sector: information technology, healthcare, consumer staples, consumer discretionary, finance, materials, industrials, energy, telecommunications, utilities, and real estate. If you got value from this, give me a subscription, a like, send a video to a friend, and have that friend send it to another friend. Keep getting educated so you can teach your children and break the cycle of generational poverty. Until next time, continue to command your money to grow. MD Investor out.